To buy or not to buy? That is indeed the question. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We get a steady flow of questions from those who read our research or follow our posts, but one question more than any other we get asked is, should I buy property now? Many cite the real estate industry claims that now is a great time to buy it, but is it really? So today we're going to explore this question, but with a caveat. This is not financial advice, it's simply my opinion based on my own research and surveys. Your mileage may vary. And of course the markets are different across states and locations, but it is an important question given that home prices appear to have reached something of a peak and indeed may be sliding in some areas. Housing in Australia is unaffordable, as the recent Demographia report showed, and banks are tightening their lending standards under regulatory pressure. And also net rental streams are looking pretty stressed, and many households are under severe financial pressure, and mortgage interest rates are likely to rise. But of course we have a generation of home buyers and prospective home buyers who have only ever seen home prices rise. And if you're in the property owning system, it has become a significant source of wealth creation, amplified if you're a property investor, and assisted by ultra-low interest rates, tax breaks, and other incentives. But will the good times continue? Well, not necessarily. So, to decide if now is a good time to buy, consider these questions. First, why do you want to buy a property? Up until recently, our surveys have shown that the number one reason to buy was capital appreciation and wealth building. And finding somewhere to live was a poor second. But now, if you're wanting to buy to grow wealth, we say be careful as the market dynamics are changing and it's likely prices will slide. Also, there may be changes to negative gearing under a Labour government. And property investment mortgage rates are likely to rise, whilst rental streams will probably not rise at all. So investment properties on a cash flow basis will be underwater. At the moment, there are much better returns from the buoyant stock market, though of course that may also change. Remember that prices crashed by 40% in Ireland, 35% in the USA, and 25% in the UK after the GFC. Prices can go down as well as up. Property is not a one-way bet. But if you are seeking to buy for somewhere to live and capital growth is less important to you, then it still may be a good time to transact. Prices are already down, and many sellers are accepting deeper discounts off the asking price to make a deal. In addition, if you're a first-time buyer, there are state incentives and really low mortgage rates available. But remember, you are still buying into a highly unaffordable market, and the capital value of a property may well fall. This could turn into a paper loss, and indeed, should you need to sell, a real financial hit. The way a mortgage works is you put in a deposit and the bank lends the rest. But in a falling market, it is your deposit which is eroded. After the GFC, many households in the Northern Hemisphere ended up in what we call negative equity, meaning the value of their mortgage was larger than the market value of their property. As a result, people were stuck, living in their properties, unable to move, hoping the market would rise again. And in fact it did over the next 10 years. So now many there are no longer in negative equity. But it can be a long and winding road. Next, if you decide to buy, do the work. First, look around at property which is available and look at recent sales to get a sense of the market. Also look in different areas and even across different states. Often locations a little further away from public transport are cheaper, but then, is the trade-off worth it? Also compare new builds with existing property. Often newly constructed homes carry a premium, which, just like a new car, on first use falls away. On the other hand, there are some desperate builders out there with big projects and a few buyers, especially in the high-rise belts of Brisbane, Melbourne and Sydney. So they may well do a deal. And we're seeing a steady stream of people who signed up for off-the-plan builds, but when it came to getting a mortgage, they couldn't find one and so cannot complete. So read the small print on these contracts and ask yourself what happens if you cannot complete the transaction. It is also harder to add any value to a new property, whereas an older one may offer more potential for investment and upgrade, and this can be a way of helping to preserve value. There is an old adage, buy the worst property on the best street, and this is still true with caveats. You should check the condition of the property so you know what you're up for. Also, do the work when it comes to a mortgage. Our research shows you can often get better mortgage rates from some of the smaller customer-owned lenders, as opposed to the big four, by going direct to them. So shop around. And whilst using a mortgage broker may help, again, we find that some of the best rates are found by borrowers who do the work themselves. Many brokers will do the right thing, but there is a risk that the commission and ownership structures of broker firms may mean they do not have access to the best rates, and they may not be working in your best interests, so be careful. There is more work to do also on affordability. A lender may make an offer of a mortgage based on your financial details as contained in the application and supporting evidence. But remember that lenders want to make a loan. It is the only game in town for them in terms of their profitability. But there is evidence that some lenders will offer a bigger loan by using more aggressive living expenses and income assumptions. That said, the industry is getting more conservative with lower affordable loan-to-value ratios and some income categories now reduced. But just because the lender says you can have a loan does not mean you should get the loan. The lender is looking at risk of loss from their perspective, not yours. If you have a large deposit, then the bank can assume that that capital is available on default to recover their mortgage. And remember, in Australia, you cannot just walk away and return the keys. The liability stays with you. So ask the lender not just about repayments at the current interest rates, but also what happens if they rise. A good rule of thumb is catering for a 3% rise in rates. Get the lender to tell you what the revised repayments would be at this higher rate. And ask yourself, honestly, if you could still make the repayments. This is important as incomes are not growing in real terms and mortgage rates may well rise. If you cannot make the repayments at 3% higher, get a smaller loan and buy a smaller place. You may need to build your own cash flow to test what is affordable. Again, do not rely on the bank for this. Remember, they are concerned about risk of loss to their shareholders, not to you. ASIC's Money Smart Budget Planner is a good starting point. Also, remember to include the transaction and stamp duty costs in your calculations. Another area is the deposit you will need. These days, you are likely to need a bigger deposit. 20% would be a good target, as this then avoids having to pay for expensive lender's mortgage insurance. Above that, you will need this facility, which, to be clear, protects the bank, not you. More prospective borrowers are turning to the Bank of Mum and Dad for help. But there are also risks attached to this arrangement. See our earlier video blog on the Bank of Mum and Dad. Some buyers are clubbing together to purchase, but then there are risks attached to these arrangements too. Finally, if you do buy, work on the assumption that you will need to hold the property for some time, say a minimum of 3 to 5 years. The old trick of flicking after a year or so will just not work if, as we expect, prices fall. Remember too that there are additional costs of owning a property, from council rates, running costs such as electricity, and maintenance costs. Owning property is an expensive business. Make sure that these costs are included in your cash flows. So what's the bottom line? If you're wanting to buy to put shelter over your family's head and can afford the mortgage and are willing to accept a risk of loss of capital, then do the work, and it might be the right thing to do. A capital gain is by no means certain in the current climate, but if you are looking at property as a wealth building tool, I think you might do better to hold off, as prices are likely to slide and the costs of an investment mortgage are on the rise. At very least, look in areas around, say, Hobart and Adelaide, where value is better at the moment. But in fact, the only reason I can see to transact at the moment in this case is to lock in a negative gearing arrangement now before the next federal election. But then that seems to me to be a long bow. And the modelling suggests that the removal of negative gearing will have only a minor impact on the market. There are a bunch of much more compelling reasons to think the market will fall. So, in summary, whatever type of borrower you are, do the work and be very careful. Prices may rise, but they can also certainly fall, and a mortgage could just be a noose around your neck. If you found this useful, do leave a post, leave a comment, and subscribe to receive future updates. And keep an eye out for our special upcoming report on cryptocurrencies and Bitcoin. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.